Welcome to the Life Success and Legacy Podcast. We're glad you're here, and we hope you enjoy the episode.
Hey, everybody. We want to welcome you back to the Life Success Legacy Podcast. My name is Chris Bay, and I'm joined by three mics. How are you, gentlemen?
Hey. Doing good.
Excellent, excellent. Let's jump right in. I oftentimes have told people, using the analogy when we talk about IBC, that do you ever have like a family recipe, that's been passed down from generation to generation to generation? And within the family, everybody knows the recipe, but they will not tell anybody outside the family the secret ingredient.
Yeah.
Right? Like that's the one that gives it the zhizh, I got some word for it, but there's that secret recipe that just makes it, or that secret ingredient that makes it all come together. And I tell people that to say, look, the secret ingredient to infinite banking is regular monthly policy loan repayments.
Boom.
That is the thing that makes this go. If you increase your regular monthly policy loan repayments, I guarantee you will not be disappointed.
Mm-hmm.
Right? So let's jump into that conversation around loan repayments. And one of the misunderstandings or confusions oftentimes is that people think that if they're making loan repayments, it's going to increase their available cash value or their loan availability. Right? Have you all heard clients or seen clients have that misunderstanding in the past? Okay. So I'm curious, from your perspective and all the coaching sessions we do and the reading and all of that and listening to Nelson, et cetera, why do you think there is that confusion, or where does that confusion come from? Kwong, you want to say something, I could tell.
Yeah, so I just want to parse out, the assumption or claim that some people, or confusion, right, that some people have. When you do make a loan repayment, is your net available, cash value increased? Absolutely. Okay, because you paid it back. So you have the dollars again that you can use, plus the prorated interest credit to you, whatever. So that's true, right? The question or confusion comes when that total cash value may, could it be affected by loan repayments? And some people think that, that also is increased. And those are two separate figures.
Good distinction. Good
I
distinction.
just want to make sure it's clear, right?
Yeah.
So, and to answer that one, no. At any time you're making a loan repayment, no, it does not necessarily, affect or increase your total cash value, right? That's still on that track that it's built on to increase every year.
We got in the deep end really quick.
Yeah, that's what we do.
Well, I think to carry on with that, Kwong, like I think the true misconception is this is a life insurance policy. This is a contract.
Right.
The illustrations that we get are moderately accurate. I'm not saying we're trying to trace to the penny or to the cent or anything like that, but when we look at them, the amount of cash value available on the illustration, roughly, is what you're going to have each year if you pay back that loan. And even if you don't, the growth that next year is what you would have available. That new growth is what you would be able to access in addition to any existing loans that you already have. And I think that it's important to note that we coach to pay back policy loans, right? Like our theory as a team, or our principle as a team, is to follow Nelson's principles. Don't steal the keys. So if you've borrowed the money, pay the money back at some regular interval. It doesn't have to be, obviously it's likely not all at once or whatever, but don't misconstrue that with paying those loans back, increasing the total cash value available.
All right, OG is going to get back to the basics here for a second.
Yeah.
Principle number 1, think long-term. Principle 2, capitalize generously. Principle 3, which is exactly where Chris started, was don't steal from your system.
Yep.
So if you take it out, put it back. And then that's where, if you come to the boot camps, we talk about economic value added, because if you were able to make a $200 monthly policy loan repayment and the cash value grew, basically, we just are taking it out, putting it back. So the available cash value against the policy got larger. But if you put a little more in, would it get larger yet? Absolutely. So it's a matter of really sticking to the base principles of what Nelson taught. MK, you had them eyebrows down. Come on.
I just want to, caution, the messaging as well, where we don't want to say it's bad to take policy loans out. That's not at all, the case.
Oh, that's right. No, I agree.
So just to be clear, there's a right way and a wrong way when you're accessing your capital, through policy loans, right? The right way is you have a plan for it. It's going to be deployed to either pay off debt or, build an investment. And tracking where those dollars go is part of that. Being an honest banker and then repaying it as you can, right? Stay on schedule, at least the interest every year, but know that you have a plan for that. That's ideal, right? And we go ahead.
I think that's truly why we design step-by-step plans for everybody.
Yeah.
But I'm going to go to page 3 in the middle of the first column. This book demonstrates that your need for finance during your lifetime is much greater than your need for protection. And if you solve this need through this instrument, which is dividend paying whole life insurance, you'll end up with more life insurance than companies will issue on you. So because of the way we design the policies, we de-emphasize the death benefit, we emphasize the increase in cash value. But yet everybody was taught the other way. So what we're trying to do is create that plan through IBC and the way we design the dividend paying whole life insurance policy to get better every year. It gets better every year. You can't do anything about it. But in that plan, we want to make sure that as people are taking those policy loans, there is a definite plan for what they're doing. I don't care if it's paying down Visa, MasterCard, the car loan, the mortgage, or going out and doing investments of some sort. There has to be a plan. But then in the midst of all of that, there's a whole lot of things going on there. Those payments that you were making over here must come back in to pay down the policy loan balance. It can't be any simpler than that.
I think, oftentimes we talk about scrubbing our language because we work so hard to make sure what we say is true and understandable. And it just struck me that maybe when we're making loan repayments and we're talking about that, when we say it grows the cash value, I'm wondering if we replace that with we are simply replacing the cash value. Because when we make a loan repayment, it doesn't.
Ooh, that's good.
It doesn't grow, like it's not in. See, the language is hard. It's simply replacing the cash value back into your system.
So I'll add to that, and absolutely what you said. The way I word it, and I think this resonates for a lot of my folks, right, is that you get to reuse those dollars. As soon as you pay it back, you get to use it again.
Man.
So, and that is really where the power is. The multiple uses of our dollars within a 12-month period, or at any time that other people don't enjoy because they're simply using cash to do whatever. Cash is
and we've also talked about, a cup. How much water will this cup hold? This much. The policies, when we design them, they will only hold so many dollars. So it's like when you're making your policy loan repayments, you can only pay up to what the policy will hold. You cannot put any more in the cup or in the policy.
And so back to the confusion is when Nelson introduces the concept of economic value added and charging yourself for the use of your own money. In other words, putting more. So hold your cup up there again, Mike Everett.
All right.
If we've borrowed all the water out of that cup, and we're paying it all back plus economic value added. So if we're paying back $250 a month and we decide, no, we're going to do $275,
Yep.
Where's that extra $25 going to go into? And that's where I think the confusion is. And what Nelson was talking about is not just one policy.
That's
He's
exactly
talking
right.
about a system of policies.
Oh,
Also, I want to point out, Nelson doesn't show anyone taking a loan for at least 4
there you go.
years. So that cup has gotten much bigger and has much more capacity to hold more of that EVA, those extra payments.
Yes.
With our policies that we design for people, oftentimes our clients are taking loans in the first 2 weeks to turn wind current on credit card debt, et cetera, right? And if they apply EVA, is that first little bitty baby policy in its first year going to hold that EVA? It's not, right? So that's why if you've seen our software, you've seen an example, we have a miscellaneous account to hold that overflow that the cup won't hold.
Yes.
Why is it there? Because we want that money to still, we want you to still develop that muscle of monthly loan repayments, and we'll use that cash value and that extra miscellaneous for the next year's premium deposit.
Yeah.
But that usually only happens in the first year or two.
Yes.
When it's a baby policy.
Yes. And so using that logic, if we were to wait till the 4th year in all of our policies, I don't care if it's a 5K or a 50K policy, the volume of that cup is so much larger that even if they borrow it all out all at once to pay off debt or investments or whatever they use, the likelihood that they would pay it all back in that first year is almost zero. Not saying it's not possible, but it is almost zero because the policy is just growing. And again, remember the booster rockets. We're not getting into policy design, but our booster rockets have made that cup huge in those first 4 years. You borrow all that out, you're not paying it all back. But going to Chris's statement, we teach people to do it in the first 2 weeks in most cases. So the cup is smaller, and it's just a matter of creating that habit.
Most of the people that are listening to this podcast are either customers or they're thinking about being customers. So I'm going to, what you said right there, MC, was absolutely perfect. So I'm going to go to our software for a second. Because when we're talking about the 4 years for the equipment finance and the 7 years for the twins, they don't take a loan until their policies are capitalized, which now you were talking about when we take policy loans, the chances of them paying off, and let's just use a mortgage, for example. They're not going to pay that mortgage off in the first 1 or 2 years because we're not going to build the policies big enough, et cetera, et cetera. But then I was thinking of that very thing that you were talking about. Remember every now and then when we drag out the mortgage and we say, hey, let's get it out of there. So what we're doing is we're building the internal capacity of the policy to where if they get down to year 7, 8, or 9, there is a bulk amount of money to where they could either pay off a larger debt, which is usually a HELOC or a mortgage, or they want to go out and do income stacking, or they want to go out and purchase some real estate or some kind of investment. So there's a reason why Nelson called it the infinite banking concept, because there are infinite possibilities of what you could potentially do with the capital that we're talking about right here. But then being responsible. If you take a giant or a small policy loan, we've got to be responsible, which really that's what our whole messaging is today, is if you take it out, you must put it back. And you're not going to put back a mortgage amount in a year or two. It's going to take time. So this is why when we're utilizing the system, we want to do it efficiently and effectively for the client. And then MK was talking about the fact that regardless of the amount of dollars that you pay back into the policy loan balance, those dollars are available again to reuse.
And just to add back or run back to the cup example, okay, that first distinction that I made, is evidenced with the cup example perfectly. When you add back more to your monthly payment, or pay back more than you owe, you're just refilling that water. This is the confusion when they say does it add to my cash value, is that it's going to increase the size of the cup by paying back more. No, that's growing it versus growing the cup. The cup will grow every year. But that's really by, function of the dividend, buying more paid up additions and building that
Premium.
capacity over time. But on a monthly basis, even annually, just by repaying your loan, okay, that's, remember, one avenue that your policy can accept dollars through. It's a dollar for dollar benefit, absolutely, plus the interest, that you prepaid. But yeah, you're not growing the cup just by paying more policy loan back. Certainly
Chris
with,
mentioned,
yep.
yeah, Chris mentioned earlier, and this is on page 25. Furthermore, I'm not describing one life insurance policy. This is to be a system of policies.
Yep.
And then he uses the example of the grocery store.
Yeah.
If the grocery store is doing great on the west side of town, are they going to put a grocery store on the east side of town? So that's a matter of, once you have paid back that policy loan, because back to the simplicity of this, if you're paying $250 a month and it's working, and you decide to pay yourself $275 a month, is it going to pay the policy loan off quicker?
Yeah,
that's it right there.
Well, wait a second here. If you still have amortized that loan out for another year or two, what are you going to do with the excess capital? You're going to start another policy. It's almost too simple.
Yeah.
Sorry, got excited there.
We just had that conversation this week with some new clients, and I was sharing their strategy with them. And they're in a situation where they don't have access to a large pool. So they're starting with a smaller policy, but they're overpaying on a lot of their debts, credit cards, et cetera. So they have a lot of extra cash flow, right? So what's happening is they are paying down or paying back they're replacing those dollars in their policy from taking loans. They're replacing that loan within the first 2 or 3 months of the first year. And I asked them, I said, now you're just storing, and I'm showing them with the software, you're storing all this money in your miscellaneous account. Do you think you should just let that money sit there till next year? Because they've got more debt and things like that. And I said, what are some options that you could consider with those extra dollars? And I said, I always tell people, have a plan for next year's premium deposit. But then any extra, what could you do with that? And they said, well, one of them said we could start the other policy because they want to start a second policy. And also we could pay down debt. He said, or we could pay down debt. And I said, could you do both? Could you start that second policy, run some dollars through it, pull the cash value out, and then pay down some more debt, and have a plan for both premiums coming up in the future?
And have you done this before, Chris?
So if each policy is a contract, that contract, that is a cup.
Yes.
That cup can only increase on an annual basis in the form of dividends and premium deposits. So that cup that Mike's been holding for the first 12 months, it's going to stay that size.
Yeah.
So if you're applying economic value added, or you pay back that, you replace those dollars back into the policy from your policy loan, and you've got more dollars flowing, it can't increase the size of that cup at that point. But those dollars can be available for other options, future policies, paying down more debt, etc. Okay. So we just want you to know you cannot increase the size of the cup during the year by replacing more dollars than what you borrowed.
And I will say, from the book, page 27, in the review of part 1, Nelson says, it's going to take time and discipline for several years. Don't expect to get rich overnight, but the rewards later on are worth all the effort. And I think that it's always a matter of level setting expectations. We can't get deals in life insurance. We've said that 1,000 times. We'll keep saying it. What we can do is just like what Chris described, or what Mike described, or both Mike Kwong and Mike described, is strategic planning and having an idea of where the dollars are going, how to pay premium deposits for the next year, and what could be done with any potential excess cash in the event you have it. So I think it's all just a matter of our coaching is available for that. Like, our team is well equipped to handle those conversations because we either do it ourselves. What do you say, Kwong? eat our own cooking.
Eat what we cook.
And I think we are, and individually, even just the four people on the screen, not including the other part of our team, the other people on our team have extremely unique positions or use cases that we've experienced or worked with clients to experience in their lives through infinite banking. So I think it's important to realize that, there's a lot of opportunity out there for creativity.
Mm-hmm. Before we tie a bow on this conversation, I do want to touch on, the four things that IBC does: eliminating outside debt, building your warehouse of wealth, passive income, and then tax-free wealth transfer, right? Those folks who are working on their passive income are clients, and they've got their dollars out there taking loans against their policies, and they're investing it and using it in a variety of different ways.
Mm-hmm.
Sometimes there is the conversation of, I'm going to max out my loans against my policy and I'm going to get those dollars working, and they're doing all these things for me. Should I, or when should I care about making loan repayments if those dollars are working for me? So I'd love to have a quick little conversation about that piece. MK, go.
Yeah, so this ties on to another question that some people ask, and this is, I understand it's a theoretical one, maybe for some people it's more real, but can I break my policy by borrowing too much?
Yeah.
Okay, let's get to the heart of it right there. No matter what you're doing with the loans, we already assuming you're doing responsible things with it, it's making money or it's paying off debt. Okay, remember each year at minimum, you have that interest payment. Now, assuming that you're maxing it, okay, you're hitting that, is that going to possibly break my policy? Okay, it's simple words, and as much as we always say, pay back your loans, put the piece back on the shelf, pay yourself back, be an honest banker, and I don't think that you can, because the insurance the companies themselves are too smart. They understand, they've been around for over a century. The way they craft the policy loans, remember the wrinkle where they take that interest first, right? Mm-hmm. They already forecasted how much that interest is going to be, and they hold back the amount from the principal that you can borrow. Now, every year, what happens, right? On an increasing efficiency basis, your policy is growing, right? Whatever you can borrow, it's still going to be that same interest rate that they've already forecasted. So if nothing else, even if you didn't pay the interest, here was the question specifically. If you don't pay the interest, we already covered this, where the interest will roll onto the principal, okay? Mm-hmm. Great, that's fine when you've got plenty of excess cash value, right? What about when you're already at that max or close to it, right? That's the question specifically.
Yes.
And honestly, I've done the math, and others can I don't know, confirm this, but the growth is always built so that it will increase enough to accommodate for that additional principal that the interest will add to it if you don't pay. So that was a lot of words just to say that they've already figured that out. And ultimately, at the very end of the day, worst case scenario, you owe all this money when you pass on, we graduate, jump off the earth, whatever, right? That death benefit's always there. And
it is
appreciably more than any of the interest plus all the principal you've ever borrowed.
Yeah.
So, I just, yes, we want to hammer down good, habits, be an honest banker and all that stuff. But I don't want to start fear mongering about, policy loans. Trust me, they're built, to withstand it, Now, whatever you've invested in through your policies, that's what I would worry about. Mm-hmm. Okay, focus on that. But just know that your policy is strong. It's built for this. It'll handle that.
I'm thinking of a foundation. Yep. We have, when we design the policies, we design them with a firm foundation.
Right.
And we make sure that when the storm comes, because the storm is coming, whether it be them not making the policy loan repayments, them not making the interest payments on the annual
premium. That's
key. Right. That's it. So we have built the policies to be able to take the storm, but yet we're trying to help people create that rhythm, to create that necessary discipline to make those policy loan payments, because it's going to benefit them.
That's right.
Yeah.
Yep. Very good.
As Kwong is famous for saying, we build these things pretty tough.
Ram tough. Doesn't mean
ram tough, baby.
It off a cliff.
Don't drive it off the cliff. So that's why, Nelson taught these principles. He even wrote his book, he didn't show taking loans in his book. And that's because people had such a mindset against loans that he
That's
thought it would really
right.
offend them. So when people read Nelson's book, they get confused about that. There were things that he did intentionally because he knows humans and the human
Yep.
problems.
Yep.
And
Parkinson's.
and could you max out your policy and not pay back loan repayments and let the interest, take care of itself?
Mhm.
Maybe,
Mhm.
but
Mhm.
why do I want to drive it off the cliff?
Yeah.
Right.
So over time, if you let that policy loan just get completely out of control, at one point in time, you're not going to be able to afford the annual interest that's going to be due on that policy loan. Do not do that.
Yeah.
So when we are taking loans against our policy to pay down our debt, our own personal debt, and make those payments back, replace those dollars back in our policies,
Yep.
where does the risk lie in that model? It lies with me.
Mm-hmm.
So let's turn the coin. If I'm taking loans against my policy and I'm investing it with an outside source, the risk increases. So there's a factor there that I don't know that I'm necessarily going to get all of those dollars back into my system, that I'm going to replace that system. So we always talk about, look, and Mike Kwong, actually, you do a great job of this. When people are saying, well, how much should I do in loan repayments, like as a minimum? What should be my thought process if I'm wanting to get my dollars working for me and doing all these things out there? What is a reasonable approach to making loan repayments?
Yeah, one rule I often, support is, consider, your base premium, whatever that annual amount is. And again, from the first year to the last, it's the same. So we can count on that. Take that amount and divide it by, say, 11 is what I would recommend. And then set that amount back as your monthly repayment on an automated schedule that you don't even have to worry about or think about. Now, what happens? Even if you don't make any extra loan repayment, assuming, again, you're not continuing to borrow out more, 3 or 4 months later, you will have at least enough of repaid cash value at your anniversary that you can count on. Worst case scenario, you don't have a new dollar at all. You can borrow from the policy to cover for the next 12 months.
Yep.
And we're just talking like base, like just, I mean, that's not
Right.
what we would necessarily recommend. But if you just want to know, like, base level, what's a good approach for making sure I've covered my bases,
Yep.
that's a good way to think about it.
Mm-hmm.
Yep.
That's
Yeah.
certainly opposite or different than having that EVA approach where we're like, hey, put extra into it and then you can use that money again. This is just saying, hey, if you just want to cover your base premium, that's an approach you could use to think about.
Yep.
Yeah.
Mm.
Okay, gentlemen, good discussion. Actually, I feel like in this recording, we actually have been kind of refining our own language and our own conversation around loan repayments and all that. So it's good. As we tell people all the time, this is a community of learners. I mean, I learn from my clients often, things that they're doing, things that they're trying, those kinds of things. I had a client yesterday ask me, okay, here's where we are. What do you recommend? And they were asking me something that I haven't done myself. And I said, I'm just going to be straight up with you. I don't feel comfortable recommending something that I don't recommend, you eating something that I haven't cooked. I don't know if that's the right analogy, but I like to cook it first and taste it and make sure it's good before I recommend it to somebody else. So,
And just to add to that, we have other coaches that have, much more, exciting palates, right? That may have tried things before, so we're a team is my point too, right?
Yes,
Chris?
absolutely. And that's that. And we have not just the four mugs on this screen, but we have other folks on the team who have tried different things as well. So look at you throwing palette
Well,
into the Life Success Legacy
what I
podcast.
love about this team, the four of us, and then our others, is we all are like-minded. We're all having the same conversation, and we're all using the same language in order for our customers to have some continuity.
Mm-hmm.
And I think that this kind of goes back to, we want to inspire financial hope and freedom by revealing little known truths about money while investing and trusting long-term relationships. Those relationships aren't just outside our sphere, they're inside our team.
Yeah.
This is why we have way too many meetings. That's a joke, by the way. But that we are really wanting the continuity to not just happen for our clients, but we want that same continuity internally with our team. I think that's what sets us apart from many of the organizations out there, and I love it.
Yeah.
Yeah, I'm a proud father right now.
Guys, thanks for the conversation as always. I always learn something from listening to you guys, and or I'm reminded of things, and it sharpens our language. And we always
Beautiful.
want to make sure that our message is scrubbed for our clients.
Mhm.
So thanks for listening to us all. Check us out at lifesuccesslegacy.com. Please join us for a webinar, a boot camp. If you're a client, we have front porch, monthly front porches, where it's a Zoom that we all come together. You can check that out on our DIBS WhatsApp or our LSL Discord. We'll have those links available so people can jump on. And it's really just a time to get together. We do Q&A. We share ideas. So check us out there. And we'll look forward to the next time with the LSL group on our next podcast. Thank you.